Joining us right now to help decipher what comes next for stocks. On the technicals, we've got Rich Ross, head of technical analysis at Evercore ISI. And on the fundamentals, we've got Greg Branch, managing partner at Veritas Financials and a CNBC contributor. Greg, I'm going to start with you.
Sure.
What are you thinking? And what are you thinking we're going to be hearing from the Fed? I mean, I don't know how much you think that's even going to matter at this point. It's been such a weird and wild week.
Yeah, I don't think we'll hear anything surprising from the Fed that we hadn't anticipated. The posture will remain hawkish as we expect the inflationary pressures to continue over the next quarter, certainly, and likely into the mid-spring. I don't really expect any abatement in those pressures until we start to lap some of those four handles in May. So, you know, the stance is cautious from here. There are top-line concerns, not only due to Omicron, but due to potentially softening consumer demand as we shift from physically supported consumer demand and monetary policy.
Well, I'll go before I go to Rich. Greg, what do you do about it? What do you do? Right? You have Kathy Wood on one side who says this is a massive sale, and other people who say we are so far from the bottom.
Right. I think there's a pathway in the middle somewhere, Andrew. You look for safety. You look for companies that have sustainable demand, no matter what the macro environment is, no matter where the demand is coming from, that have proven that they can sustain it, like Microsoft, which performed in an environment where pre-Omicron and during Omicron, and certainly will after Omicron. You look for defensible margins, those who are insulated from inflationary pressures. And some of that's in Kathy Wood's world, and some of that's in value world.
Okay, I got to get to Rich here because he's got the charts, and I need to know, what are they really saying?
Well, first on the Fed, I think our view internally within Evercore is consistent with where Greg is coming from, that the Fed put, proverbially speaking, is well below current levels, Andrew. And in fact, the hawkish pivot is really designed to do exactly what it's done, which is to take the starch out of an overheated equity market. In terms of the charts themselves, which is really my very narrow bike lane of expertise, Andrew, we are sitting on almost mythical support here across averages. When you talk about that 50-week moving average, you're right on the number on the S&P 500 at around 4350. The NASDAQ has had a minor violation, down 20% off the top. But again, the bigger trends remain intact. But again, consistent with Greg's view, I think there's still a reason for caution structurally. Tactically, you're staring at a market that's deeply oversold. It's at the tail end of an overdue 10, 12% correction in the S&P. Panic is in the air and it's in the flows. All of those are typically consistent with a short-term low. Again, this isn't a typical backdrop, as you know, Andrew.
You called it mythical support. Why mythical support? What's the
all eyes, Andrew? I'm getting emails from people that trade every corner of this market. You know, there's no atheists in foxholes, and everyone is a technician when you get a decline like this. And you can see there's one important precept that drives us as trend followers. What gets you into a trade must get you out, Andrew. That's why it's so important. When you look at the charts of the NASDAQ and the S&P 500, that 50-week moving average has defined the trend since March, April of 2020. That's almost 2 years. We've seen the S&P double. So again, breaking down below a level from which we broke out, where this rally started, this historic move going back to the COVID lows, that would be your first sign that something has changed. And I think clearly most of us can agree something has changed.
But it sounds like there's optimism in your air. Is that what you're saying? I mean, you sort of said this is the tail end of the correction. Is that what
in
the charts are telling you?
In the short term, there's reason for optimism. I would make one important point. Monday, we saw that historic reversal. Okay, it's happened, 10, 11, 12 times in history, Andrew. But when we think about the years that it occurred, 2000, 2001, 2002, 2008, in neither of those years did similarly historic reversals off the intraday lows mark a durable investable low. So I think there's two competing narratives here without speaking out of both sides of my mouth. One is a trading narrative, a deeply oversold market that's due for a bounce at the tail end of a correction, and one that may just have taken on too much damage here structurally to continue this set it and forget it one-way trend to the upside.